Hey everyone, welcome back to Corporate Decoder, the place where we decode the cryptic language of corporate speak. Today, we're diving into a report that is all about borrowing and paying up, and let me tell you, it has got some interesting implications for how this company is funding its future. Before we dive in, if you love getting straight, no-nonsense insights from official company reports, hit that subscribe button, and for a deeper dive into the world of finance, and to chat with fellow enthusiasts, join our Discord community, linked in the description below. This report is from Brandywine Operating Partnership L, and it sounds like they've just wrapped up a big borrowing deal. Think of it like a company taking out a significant loan, but in this case, it is through selling what they call notes, which is basically borrowing money from lots of people at once. So what we're seeing here is that on the 3rd of October 2025, Brandywine Operating Partnership, which we call the Operating Partnership, has successfully sold $300 million worth of notes. These notes are like iOS that they promised to pay back by the year 2031. The interest rate on these notes is 6.125% per year, which is pretty specific, and shows they really laying out the terms clearly. This whole deal is governed by a set of agreements, or indentures as they call them. Think of an indenture as the rulebook for this loan. This is a new rulebook. It was first written way back in 2004, and has been updated a few times since then. The key players here are the operating partnership Brandywine Realty Trust, which is the parent company, and a big bank, the Bank of New York Mellon, acting as the trustee. The trustee's job is to make sure everyone sticks to the rules of the agreement. Let's talk about the money side of things. This 6.125% interest isn't paid out all at once. They'll be paying it twice a year, on the 15th of January and the 15th of July, starting in January of 2026. So they're reborrowing money now and will start paying that interest back in just a few months. Now, this part is crucial. These notes are unsecured. That means there is no GPS tracking device or a specific building tied to these notes. If something goes wrong, they rank equally with other unsecured debts. However, they are pretty much at the bottom of the ladder compared to debts of their subsidiary companies. But here is the safety net Brandywine Realty Trust. The main company has fully backed these notes. This means if the operating partnership can't pay, the parent company steps in to make sure the note holders get their money back. That is a big deal for investors, showing confidence from the top. Here is where it gets interesting for Brandywine. They have the option to pay these notes back early before they even due. This is called redeeming the notes. If they decide to do this before the 15th of December 2030, basically a month before they were supposed to mature, the price they pay to get out of this debt can be a bit higher than the face value. This is often the case when interest rates have fallen since the notes were issued. It is like refinancing a mortgage when rates are lower. They'll calculate a price based on the remaining interest payments, factoring in current interest rates, and they'll pay at least the original amount back plus any owed interest. After that specific date, the 15th of December 2030, things get simpler. Brandywine can take back these notes by paying back exactly the principal amount owed, plus any interest that is due. No more complex calculations, just a straightforward buy. This gives them flexibility to manage their debt as their financial situation changes or as interest rates shift. Of course, with any borrowing, there are risks. If Brandywine doesn't follow the rules laid out in that indenture book, things can get messy. If certain events of default happen and keep happening, either the trustee or a group of note holders representing at least 25% of the total debt can demand all the money back immediately. This is a serious consequence, essentially a way for lenders to get as much of their money back as possible, as quickly as possible. Let's talk about the actual money Brandywine got from selling these notes. They sold $300 million worth, but after paying fees and costs associated with selling them, they netted about $296.3 million. It is important to note that this figure does include the interest that investors had already paid up to the sale date. So, they're re-raising a significant chunk of cash, but there are always costs involved in these big financial moves. So what will they do with this nearly $300 million? They're planning to use it to pay off existing secured debt, which means debt that is backed by collateral. They'll also use it for general company stuff, and this can include paying back or buying back other debts. This sounds like a move to clean up their balance sheet, perhaps refinancing higher interest debt with this new, slightly cheaper debt, or simply reducing their overall debt level. Here is a little nugget of complexity. Some of the people who helped sell these notes, the underwriters, are also involved with how Brandywine borrows money from its regular credit lines. If the money raised from these notes is used to pay back money borrowed from those same credit lines, then those lenders, the ones who helped sell the notes, will also get a piece of that repayment money. It sounds a bit like a circular flow of money, but it is a common arrangement in corporate finance. And to mark the occasion, on the same day the deal closed, the company Brandywine Realty Trust put out a press release. Corporations almost always do this to officially announce big financial events like this. It is their way of telling the world they've successfully raised money. This next part is more about how the company officially reports this to regulators. When a company takes on a new debt like this, it creates a direct financial obligation. It is like adding a new line item to their personal budget, but for a huge corporation. This report makes sure that the Securities and Exchange Commission, the government body that oversees companies, is fully aware of this new debt. Essentially, this section is a catch, all for anything else important that happened. In this case, it just reiterates that the press release about closing the notes offering was issued on the 3rd of October. And finally, we have the list of the actual documents filed with this report. These are like the attachments. You have the form of the note itself, the original indenture from 2004, and its supplements showing how the rules have evolved. Then there is the press release that announced the deal. These are the supporting documents that flesh out the details of everything we've discussed. Now, let us put on our Warren Buffett hat and look at the bigger picture. Brandywine is raising a substantial amount of money, $300 million, which is a clear sign they intend to be active in managing their financial structure. They're reusing this to pay down existing debt, which is generally a good sign. It suggests they are prioritizing deleveraging or refinancing at potentially more favorable terms. The fact that the parent company, Brandywine Realty Trust, is fully guaranteeing these notes is a strong vote of confidence. It signals that the parent believes in its subsidiary's ability to manage its obligations and is willing to back it up. However, we also see that these notes are unsecured and subordinated to some other debts. This means that in a worst-case scenario, these note holders might be among the last to get paid. While the parent company's guarantee mitigates this significantly, it is still a detail to be aware of. The interest rate of 6.125% is a bit higher than what we might see for the most creditworthy companies, suggesting that investors perceive some level of risk, or perhaps it reflects the prevailing market conditions for real estate investment trusts, or REITs, at the time. Looking ahead, this move gives Brandywine Operating Partnership more financial flexibility. They can use this capital to invest in new projects, pay down more expensive debt, or simply strengthen their financial position. The key will be how effectively they deploy this capital. Are they growing their income, producing assets with this money, or are they just shuffling debt around? The general corporate purposes and debt retirement could mean a variety of things, so focusing on their future investment strategies will be important. So, in conclusion, Brandywine has successfully secured a significant amount of funding. This is a strategic move to manage their debt. The parent company's guarantee is a positive indicator of stability and commitment. While the unsecured nature of the notes and the interest rate warrant attention, the overall picture suggests a company actively managing its financial health. Alright, that is our breakdown of Brandywine's latest filing. What is your take on these numbers and what they signal for the company's future? Let us know your thoughts in the comments below. If this analysis was valuable, hitting that like button really supports the channel. And of course, subscribe for more uncensored corporate breakdowns. Don't forget to check out the Discord link in the description to join the conversation. Thanks for watching, and we see you next time on Corporate Decoder.